Good morning friends. Today I discuss is international finance. International finance is the division of economics which is concerned with the study of various concepts such as foreign investment, exchange rate and their effect on international trade. This branch also analyzes international investment, capital movements, cross-border projects, trade, futures, currency, swaps, and options. International finance and international trade theory are main concept of international economies. Next, feature of international finance. First, foreign exchange risk. Foreign exchange risk means an understanding of foreign exchange risk is essential for managers and investors in the modern day environment of unforeseen changes in foreign exchange rates. Second, political risks. Another risk that firms may encounter in international finance is a political risk. Political risk ranges from the risk of from unforeseen government action or other event of a political character such as acts of terrorism to outright of asset held by foreigner. Third, expanded opportunity sets. When firms go global, they also tend to benefit from expanded opportunity which are available now. They can raise funds in capital market where cost of capital is the lowest. Market imperfection. The final feature of international finance that disguises it from domestic finance is that world markets today are highly imperfect. There are profound differences among nations, law, taxes, systems, business practices, and general culture environment. Next, principles of international finance. Risk return trade off. Risk and return need to be optimized in order to maximize the return stockholder. A project with higher risk is expected to generate higher return and vice versa. Similarly, that if a project offer a high rate of return, it can be summarized that is essential higher risk as well as market imperfection, perfect competition, essentials, free entry and exit from the market, making goods and service highly transferable and mobile. Portfolio diversification. The overall risk of a portfolio decreases as it is made more diverse by the addition of more asset. This is the main reason behind diversified portfolio held by MNCs. For example, Pepsi sells its products in different countries to balance its currency and growth risk. Comparative advantages. This theory suggests that international trade can help the participant country in increasing their standard of living. It allowed the countries to carry on the occupation best suited to their environment and capabilities. Internationalism advantages એમાં ફર્સ્ટ છે લોકેશન છે ઓનરશિપ એન્ડ ઇન્ટરનેશનલાઇઝેશન factor of outcomes internationalization advantages. Economics of scale occur due to synergies which imply that the whole is generally worth more than the sum of its constituents. Valuation undervaluation principle and asset value equals to the present worth of its future earnings. Various studies have shown that MNCs earn higher profit than domestic companies and that the earnings of the large firm enjoy. Capitalization risk અથવા તો rate. Importance of international finance. Importance of international finance. First, easily borrow and lend. A country can easily borrow and lend according to its requirements with access to capital market. Second, growth and domestic investment. International finance helps in growth and domestic investment by boosting capital imports. Faulty regulation of money. Faulty regulation of money in a country may be countered by global cash flow. Promotes better. It promotes better financial and banking system and enables to withstand competition. Helps to other. It helps is easing capital flow and thus brings about more equality amongst participating nations. It promotes better integration of international economics which leads to easy fund transfer. Thank you. Like and subscribe. Do it.